In this video, we'll break down what a Roth IRA is, how it works, and the benefits of having a Roth IRA. A Roth IRA is a retirement account that you open on your own, not through an employer like you would with a 401k. You contribute after-tax dollars to a Roth IRA. This means that you pay taxes on the money you contribute now, and you don't have to worry about paying taxes when you withdraw the money later in life. Once the money is in your Roth IRA, you invest it so that it can grow over time and prepare you financially for retirement. You can contribute to a Roth IRA as long as you have taxable compensation, which could be wages, a salary, or tips. You also must have a modified adjusted gross income, often called MAGI, under a certain amount. For the tax year 2021, you can qualify if you are single or married and filing your taxes separately and earn under $125,000. If you're married but you file your taxes jointly, you must earn under $198,000. Now for the tax year 2022, those limits are a little bit higher. If you're married filing separately or single, you must earn under $129,000. If you're married filing jointly, you must earn under $204,000. Now you can still contribute money if you earn a little bit more than this. You just can't contribute the full amount. So you can contribute a reduced amount depending on how much you earn. But you could reach a point where you just earn too much to be able to contribute to a Roth IRA anymore. The most significant thing to remember is that if you are married and living together, but are filing separately, then an individual must earn under $10,000 per year to contribute to a Roth IRA. For example, let's say you earn under $10,000, but your spouse earns more than $10,000. You can contribute to a Roth IRA, but your spouse cannot. You can contribute up to $6,000 a year to your Roth IRA, or $7,000 a year if you are age 50 or older. Now, in a typical tax year, the deadline to file your taxes is April 15th, and you have until April 15th to contribute money to your Roth IRA for the previous year. For example, for the tax year 2022, you have until April 15th, 2023 to contribute money to your Roth IRA for 2022. You can withdraw money that you have contributed to your Roth IRA at any point without paying taxes or penalties. You just might have to pay something extra if you withdraw earnings that you've made from your investments in your Roth IRA. So let's say you contribute $25,000 to your Roth IRA and you've earned a few thousand extra dollars from your investments. You can withdraw up to $25,000 without paying anything extra. It's just if you withdraw more than $25,000 that you might have to pay some taxes or penalties. And there are some exceptions to having to pay extra if you withdraw those earnings. For example, certain medical expenses, you can withdraw that money without paying extra, or if you are using that money to buy a home. If you are age 59 and a half or older and you have had the account for at least 5 years, you can take out money from your investments without paying any taxes or penalties. You do not have to pay any taxes when you withdraw money later in life. You've already taken care of all of that on the front end. You can also withdraw earnings from your investments penalty-free once you've had the account for at least 5 years. There are also no rules about having to withdraw money at a certain age or about a minimum amount you have to withdraw like there are with a traditional IRA. Here are the cons of a Roth IRA. You have to earn under a certain amount to qualify. You can also only contribute up to $6,000 a year or $7,000 if you're age 50 or older. Now, the contribution limits are much higher with a 401k. You'll also pay taxes if you withdraw earnings before age 59 and a half. You'll pay taxes and a penalty if you take out earnings before age 59 and a half and if you've had the account for less than 5 years. The main difference between a Roth IRA and a traditional IRA is how you pay taxes. With a Roth IRA, you pay taxes on the money you put in now and you don't pay taxes when you take out the money later. With a traditional IRA, it's the opposite. You don't pay taxes on the money you put in now, but you will have to pay taxes when you withdraw money later in retirement. For example, if you work for a traditional employer, they probably withhold money for your taxes in every paycheck. You receive that paycheck and you can put that money into your Roth IRA. You don't have to worry about paying taxes on it. That's already been taken care of. If you are self-employed, you don't have an employer who withholds taxes for you, but you can still contribute to a Roth IRA. You can just contribute your net earnings, which is just the amount you earn after business expenses and self-employment taxes. If you contribute money before your self-employment taxes to a traditional IRA, you'll just have to pay those taxes later in life when you take the money out. A Roth IRA is a good option if you earn under the income limit, and if you think that you'll pay less in taxes now than you would later in life, because then you'll ultimately pay less in taxes. And for this reason, Roth IRAs are usually good for younger people. You have a lot of options for which company to use to open your Roth IRA. And most of these companies will work with you to assess your risk tolerance and help you decide how to invest the money. The most important part is to remember that once you have the money in your Roth IRA, then you need to invest it. Otherwise, it's really no different than just having it sitting in a savings account, and it won't grow over time to earn you more money for retirement. It's also important to remember that you don't have to choose just one type of retirement account. You can open a Roth IRA, traditional IRA, and 401k if you want to.